When it comes to investing, the goal is to buy high quality assets that increase over time. That could include things like real estate, bonds, ETFs, index funds or mutual funds, or even individual stocks. We're all looking for a total return. What if I told you that you could buy one of the strongest businesses in the world today at a 20% discount? The company that we are looking at today is one of the largest in the world. They have a great portfolio of products, a great business model, and they pay dividends, growing dividends each and every year. If that sounds great to you, then I think you're going to love today's video. Hey everyone, Mark Rusin here, and before we jump into today's video, do me a huge favor. Click that like button down below as that helps the growth of this channel. And also subscribe to the channel so you are notified anytime we drop a new video. And also, I want to take a moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great tools and products for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up completely free for their list of the top 10 stocks to buy right now. The stock that we are looking at today is one that I have held in my portfolio and continue to add to on a regular basis. This stock is also one of the largest technology companies in the world. They have huge cash flows, which allow them to not only pay a dividend, but to pay a growing dividend each and every year. And the company, when you think about it, is in the technology sector. We cannot imagine a world without technology. Going forward, I don't see a world that's going to be using less technology. I see a world that's going to rely more on technology. Not too often do opportunities come around when you have the ability to buy a great company at a great price. The great Warren Buffett once said that price is what you pay, value is what you get. And remember, as price goes down, we get a great valuation and also a higher dividend yield. If you recall, price has an inverse relationship to the dividend yield. As price goes up, dividend yield goes down. As price goes down, dividend yields go up. All right, enough of the hints. Let's get to the stock we are going to discuss today, which is Microsoft Corporation, stock ticker MSFT. Let's first begin with the company overview. Microsoft currently has a market cap of $1.9 trillion, making it one of the largest in the world. They are a global hardware and software company with offerings all over the world. The company was founded in 1975. They break out their revenues into three operating segments: productivity and business, intelligent cloud, and personal computing. Some of the primary operating products include Azure Cloud, which is one of the largest cloud providers in the world, the Xbox gaming system, Windows operating system, Microsoft Office products such as Microsoft Word, Excel, PowerPoint, and many others. They also have Search, which is interesting given all the popularity that has been given around ChatGPT, which we will get into. The great thing about Microsoft is they are a well-diversified company. When one segment does poorly, like we've seen with the PC segment, there's other segments that are doing quite well, and cloud computing has been that segment. Like I said, the truth of the matter is that our society is not becoming less reliable on technology. Believe it or not, it is becoming even more reliable on technology. This plays perfectly into the hands of Microsoft, considering they are, after all, one of the largest in the space and continue to grow. The Microsoft operating system and Office are really what started it all for Microsoft, but they continue to expand their offerings. Office at one time needed to be downloaded with a disk or a CD. Now you can add a subscription to all Office products and pay a recurring fee, and for investors, we love subscription revenue. But now the company has also expanded into things like gaming and cloud computing. 2/3 of the world's cloud revenue is earned by three technology giants. Amazon's AWS being the largest, owning 34% market share. Microsoft's Azure is the second largest cloud provider, owning 21% market share, followed by Google Cloud, which owns 11% market share. According to Grand View Research, they expect the cloud sector to grow nearly 15% per year through the year 2030, which gives plenty of runway for these major cloud providers. Also, with artificial intelligence being the next hot thing, this creates even more need for cloud. Speaking of artificial intelligence, or AI, Microsoft invested roughly $10 billion in the maker of ChatGPT. They have rolled out Azure OpenAI, allowing businesses to integrate AI tools into their own cloud apps. It will also soon include access to ChatGPT as well. AI is the new hot thing that Microsoft clearly is leading, and Google is launching their own AI product as well. AI is the new buzz, but it could lead to a new bubble as well, so something to be aware of for investors. Another area the business has been expanding has been with gaming. The expansion has been both organic with their Xbox console, but also through acquisitions. The company has acquired ZeniMax Media and its game publisher Bethesda Softworks for $7.5 billion. This is one of the largest private game publishers in the world. The acquisition you may be more familiar with is the company's pursuit of Activision Blizzard, stock ticker ATVI, which is currently going through various approvals and running into some roadblocks. Activision is a major player in the gaming space with many popular gaming titles, including Call of Duty. And that is one of the primary reasons the likes of competitors like Sony is putting up such a fuss with regulators regarding this acquisition. The gaming sector continues to expand as we saw a lot of demand pulled forward during the global pandemic. The next section of the business we're going to look at is the recent financial results. Microsoft recently reported their Q2 2023 financial results. So although these results are as of December 2022, these are the company's Q2 earnings. The company reported revenues of $52.7 billion, which was a 2% increase year over year, actually one of the lowest in the past few decades for the company. Operating income was $21.6 billion at an adjusted level, down 3% year over year. Net income came in at $17.4 billion on an adjusted level, down 7%. So overall, the quarter was just okay. We know there was a lot of demand that was pulled forward during the global pandemic, which shot revenues higher in those 2021 periods, which made for difficult comps in 2023. We are also aware of the slowing PC sales. We've seen that in reports from Intel, AMD, and Nvidia. Another headwind outside of PC results has been the continued headwind regarding currency. And when you look further at the report, you can see on a currency neutral view, revenues were actually up 7% and operating income was up 6%. Let's now look at the three segments I mentioned at the start: productivity and business process, intelligent cloud, and personal computing. During the quarter, the productivity and business processes segment generated revenues of $17 billion, which was up 7% on a GAAP level, but up 13% looking at a currency neutral level. The intelligent cloud reported revenues of $21.5 billion, so this is the largest segment. That was up 18% and 24% currency neutral. Personal computing, which we expected to be weak given what we have seen from others, their revenues came in at $14.2 billion, down 19% year over year and down 16% currency neutral. In terms of free cash flow, the company reported Q2 free cash flow of nearly $5 billion, which was a decrease of 16%. Over the past 6 months, the company has generated nearly $22 billion in free cash flow, and they have paid out $9.7 billion in dividends, which equates to a 6-month free cash flow payout ratio of roughly 40%. In addition, the company has bought back $11 billion in shares, so overall they have returned nearly $21 billion back to shareholders by way of dividends or share buybacks just in this 6-month period. So now we've looked at the company overview, we've also looked at recent financial results. Now let's take a closer look at the dividend. Microsoft currently pays an annual dividend of $2.72 per share, which equates to a dividend yield of 1.1%. Not a huge year one dividend yield, but one must understand that the growth of the company we have seen over the past 5 years has been tremendous. Over the past 5 years, shares of Microsoft are up 215%. That is an average annual return of more than 40% per year. The company has also increased their dividend for 20 consecutive years, making them a dividend challenger. As we mentioned, yields go down when stock prices go up. There are two ways for a dividend yield to increase. You could have the stock price go down and the dividend yield go up. Likely not something you always want to see, but another way is through dividend increases. And over the past 5 years, Microsoft has been hiking their dividend at an average annual rate of more than 10% per year. So they are paying out more and more every single year, but the stock price gains have been far too much for that dividend yield to make any headway higher. But that's a great thing because remember, with investing, it is a total return investment. This is a very similar story with the likes of Apple. When it comes to the dividend is plenty safe, as they have strong free cash flows and they also have a AAA rated balance sheet, a AAA rated credit rating that is higher than the US government as a whole. Before we move on to the next section, let me tell you about a special promotion over at Webull. Right now, if you open a new account over at Webull and deposit any amount of money, they will give you up to 12 free stocks that could be valued up to over $30,000. Make sure you use the link down in the description below. So finally, let's take a look at guidance and valuation. Where does the stock go from here? And is it a good buy? Microsoft stock was hit rather hard after they announced their Q2 earnings, but have since recovered those losses and some. Investors were not as much disappointed on the slowdown in results in Q2, as a lot of it was baked in, but instead they got concerned, briefly, about the Q3 guidance management released. Growth has been slowing in certain areas of the business, as you can see in this chart, which shows revenue and growth by products and services. Azure growth continues to fall, but hard to argue still with 31% growth year over year. Windows OEM turned negative in a big way in Q2, down nearly 40%. But as you can see back in Q2 2022, that was a tough comp period. Moving forward, management believes the Q3 revenue will be between $50.5 billion and $51.5 billion. So falling further from what we just saw in the 3 quarters prior, with Azure growth continuing to slow down further. Due to this slowdown, the company is also cutting its workforce to better align themselves economically. So with that being said, is Microsoft a good buy here? Over the past 12 months, shares of Microsoft are still down 12.5%, even after being up 12% in 2023 alone. Microsoft trades at a next 12 months EBITDA multiple of 16 times, which is still above their 10-year average of 14 times. Although Microsoft needs to deliver the promise from its OpenAI partnership and their ChatGPT, which could further bring the growth higher for the cloud segment. Analysts are looking for June 2024 EPS of $10.81, which equates to a forward earnings multiple of 23.7 times. Over the past 5 years, shares of Microsoft have traded closer to an average of 30 times. And if we look even further out, over the past decade, the stock has traded at an average valuation of roughly 25 times. So right now, on a forward-looking basis, the stock looks appealing as it is cheaper on both levels. Given the strong run-up that we have seen from the S&P 500 and especially the NASDAQ, with a lot of technology companies running hard here at the start of 2023, I do expect a little bit of a breather. Now, although the shares do look appealing right now, I could see adding a little bit here, but waiting for that larger pullback in order to add even more money to something like Microsoft. Down in the comments section below, let me know what you think of the company as a whole, of Microsoft, the company, and also right now, do you think they are a good buy? And if you haven't done so yet, make sure you smash that like button down below and subscribe to the channel so you are notified anytime we drop a new video. With that being said, I appreciate it and thank you for watching. We'll see you in the next video. Take care.